Welcome to our deep dive on governmental 457(b) plans and why tax diversification often beats going all in on either Roth or traditional. We will unpack Roth versus traditional contributions, the unique withdrawal advantage of governmental 457(b)s, the way pensions change the math, and the strategy to avoid expensive conversions. Along the way, we will include practical decision frameworks, diagrams, and a couple of quizzes to test your understanding. Let's begin by outlining where we're headed. Here's the roadmap for today. First, we'll quickly cover 457(b) essentials. Next, we'll tackle the Roth versus traditional decision using the lens of progressive tax brackets. Then, we'll discuss how a pension can change the calculus. After that, we'll define a tax diversification strategy, explain why big conversions can be costly, and show how the 457(b) can be used as an early access bridge. Finally, we'll wrap with when to tilt Roth versus traditional and key takeaways. Let's transition to an important disclaimer. This content is for educational purposes only and is not tax, legal, or investment advice. The details of your situation matter, and tax laws change. Before implementing any strategy, consult a qualified tax professional or fiduciary advisor. With that foundation, let's move into the essentials of the governmental 457(b). A governmental 457(b) is a deferred compensation plan for government employees. Its key advantage is that once you separate from service, you can access the account without the 10% early withdrawal penalty, even if you are younger than 59.5. You can contribute either traditional pre-tax dollars or Roth post-tax dollars, subject to annual IRS limits, and governmental 457(b) includes special catch-up provisions in the final years before normal retirement age. For Roth 457(b) money, earnings are tax-free only if the distribution is qualified, which generally means satisfying both the 5-year clock and reaching age 59.5, or due to death or disability. Also note that beginning in 2024, Roth money in employer plans no longer has required minimum distributions, whereas traditional balances still do. With this foundation, let's compare Roth versus traditional contributions using the lens of tax brackets. The decision between Roth and traditional hinges on the progressive tax system. If your current marginal rate is higher than your expected retirement marginal rate, traditional contributions can be advantageous because they reduce taxable income now. Conversely, if you expect to be in a higher tax bracket in retirement, Roth contributions can be more beneficial because you pay tax now and withdraw later tax-free. If you cannot confidently project future rates, it often makes sense to split contributions across both types to diversify tax exposure. Next, let's see how pensions can tilt this decision. This table summarizes the core differences. Traditional contributions reduce current taxable income, while Roth contributions are after tax. Growth is tax-deferred in traditional and tax-free in Roth if distributions are qualified. After separation from service, both avoid the 10% early withdrawal penalty. However, non-qualified Roth distributions can have taxable earnings. Traditional still has required minimum distributions, while employer plan Roth accounts no longer have RMDs starting in 2024. Traditional tends to be preferable when your current tax bracket exceeds your future bracket, and Roth becomes attractive when you expect equal or higher brackets later. Blending both increases flexibility. Now let's focus on pensions. A sizable defined benefit pension creates a baseline of guaranteed taxable income in retirement. When combined with Social Security and portfolio withdrawals, this can push you into higher marginal tax brackets. If you project that your retirement income will meet or exceed your current income, Roth contributions become more appealing because qualified Roth withdrawals do not increase adjusted gross income. This preserves room in lower brackets for other planning moves. With pensions in mind, let's move to a broader strategy: tax diversification. Tax diversification means contributing to both traditional and Roth accounts. In retirement, having both allows you to choose the most tax-efficient source of withdrawals each year. You can fill the lower tax brackets with traditional distributions while topping off spending needs with Roth withdrawals that do not increase taxable income when qualified. This flexibility can help manage exposure to Medicare IRMAA surcharges and the net investment income tax. Next, let's turn that strategy into practical contribution steps. Begin by estimating your current marginal tax bracket. Next, model your likely retirement bracket, incorporating your expected pension and Social Security benefits. If you are unsure, consider starting with an even split between traditional and Roth contributions. Revisit this annually as your income, promotions, and pension estimates evolve. Use unusually low income years to favor Roth contributions or to perform modest conversions, if appropriate. With splitting covered, let's discuss why large conversions can be costly. Converting a large traditional 457B balance to Roth in one shot triggers immediate ordinary income taxes, often propelling you into much higher brackets. This can negate future tax benefits. Conversions generally make sense only during very low income years, such as a gap period between jobs or after early retirement, before pensions and Social Security begin. If you convert, consider doing so in partial amounts that keep your taxable income within targeted brackets. With conversions addressed, let's explore how to use the governmental 457B as an early access bridge. Once you separate from service, you can withdraw from your governmental 457B without the 10% early distribution penalty. This allows the account to serve as a bridge during early retirement years before pensions or Social Security start. By coordinating withdrawals each year, you can manage your taxable income and stay within lower brackets. Many retirees preserve Roth assets for later years, when higher fixed income or RMDs might push them into higher brackets. Now let's compare scenarios where you might tilt Roth or tilt traditional. Tilt toward traditional when your current marginal tax rate is higher than your expected retirement rate, when you lack a large pension, and when current year deductions provide outsized value or help qualify for benefits. Tilt toward Roth when your pension and Social Security are likely to push you into higher retirement brackets, when you expect earnings to rise over time, and when you value tax-free growth and the absence of required minimum distributions on Roth employer plans starting in 2024. Both tilts can be combined with a core diversification approach. Next, let's test your understanding with a quick quiz. Quiz time. The question is, what single principle should drive your choice between Roth and traditional contributions? Option A, your investment risk tolerance. Option B, the progressive nature of the income tax system and your current versus future marginal tax rates. Option C, whether your colleagues prefer Roth or traditional. Option D, the number of funds available in your plan. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. The key driver is the progressive income tax system, specifically your current marginal rate versus your expected retirement marginal rate. If your current rate is higher, traditional contributions often make sense. If your future rate is higher, Roth contributions become more attractive. Let's try one more quiz focused on 457B, access rules. Second quiz question. After separating from service, how are governmental 457B withdrawals treated before age 59.5? Option A, they incur a 10% early withdrawal penalty. Option B, they avoid the 10% penalty, but normal income tax may still apply to traditional withdrawals and to non-qualified Roth earnings. Option C, they are always tax-free. Option D, they are prohibited until age 59.5. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Governmental 457B plans allow penalty-free access after separation from service, regardless of age. Traditional withdrawals are still taxable as ordinary income. For Roth, contributions come out tax-free, but earnings may be taxable if the distribution is not qualified. With the quiz is complete, let's reinforce the key points. Remember these key points. First, the progressive tax system drives the Roth versus traditional decision. Second, pensions can raise your retirement bracket, which often makes Roth contributions more attractive. Third, governmental 457B enable penalty-free withdrawals after separation from service. Fourth, tax diversification creates flexibility to manage your annual taxable income. Finally, avoid large conversions, unless you are in an unusually low-income year where the tax cost is controlled. Now, let's present one more diagrammatic overview to tie it together. This sequence diagram should show your interactions with the 457B plan and the tax authority across time. First, you make contributions to either traditional or Roth. The plan records balances separately. Upon separation from service, you request distributions, which the plan processes. The tax authority treats traditional distributions as ordinary income. Roth distributions are tax-free on contributions and tax-free on earnings only if they are qualified. Later, when pension income starts, your taxable income floor rises. You then rebalance withdrawals between traditional and Roth to manage annual tax brackets. The diagram should also note that traditional accounts have required minimum distributions at the applicable age, while employer Roth accounts have no RMDs starting in 2024. With the big picture in view, let's wrap up. To summarize, choosing between Roth and traditional is primarily a tax bracket timing decision. Strong pensions often make Roth especially valuable in retirement. Diversifying across tax buckets increases flexibility and can reduce lifetime taxes. Avoid large conversions unless you are in a uniquely low-income year. Finally, remember the governmental 457B superpower, penalty-free access after separation, which can bridge the gap to pensions and other retirement income sources. To close, I have a quick request. Thanks for watching. If this video helped you see the 457B in a new light, please like the video, share it with a colleague who could benefit, and subscribe for more practical, strategy-first content. In the comments, tell us how you are thinking about splitting contributions between traditional and Roth this year, and what your pension or promotion path looks like. See you in the next one.